Good morning, traders and investors. Roger Scott here, Senior Strategist for Wealth Press. Today's Friday. It's March 31st. Tomorrow is April Fool's. What a way to start. What a way to start the month, right? A lot of folks are asking me and sending me emails about whether the market is going to be impacted by what's going on with Donald Trump. And as you guys know, I don't like to get very political very often, but it doesn't seem to be having any effect. It wasn't even in last night's market update. So I wouldn't worry about Donald Trump's legal woes or legal worries impacting the market too much. At this point, it seems like it's moot. We'll see how it goes, and I'll keep you guys updated. But I know a lot of people were asking me this question yesterday, a lot of emails, so I wanted to just give you an update that so far I'm not seeing any impact at all. But I am seeing something really interesting. This is a 60-minute chart, a 1-month chart of the S&P 500. And what you're seeing right now is these are gap moves that occurred. We had already one gap, two gap. Now, I'm going to be very, very straight with you. Look at what happened before. Look at what happens every time these gap moves occur. It tends to come back down. So what I'm seeing right now, what I'm seeing this week is algos really driving this market high. Matter of fact, if you look at daily data, let me go to, notice one gap, two gap days in the S&P 500. That's very, 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 very rare, especially in light of what we're seeing in terms of fundamental data, which I'll get into in a minute. But in terms of market action, I'm actually seeing the algos take this market higher in order to bring it back down. I don't think this is sustainable. And we're also not getting a lot of setups right now because our setups are based on pullbacks because markets are reverting to the mean. So this trading action that you're seeing right here is very much characteristics of algos pushing this market higher with an agenda. Usually you do not have two gap days like that in the S&P. That's very, very unheard of, especially when there's no earnings on the plate or anything like that. So this is completely out of character and not very common, and most of these type of moves will revert back lower with time. So don't look at this market move as meaningful. I think this is just another way of algos just suckering traders in before taking the market back down. The markets are, in fact, very choppy. There's really no directional bias right now, and I think this will get unwound, and I'll show you why. This is the 2-year bond, okay? Notice this is a daily chart. We're looking at daily chart. For the last 1, 2, 3, 4 sessions, the 2-year, this is the 1, 2, 3, this is the 2-year bond. It's been going lower, lower, lower. When bonds go lower, that means interest rates go higher. And when interest rates go higher, there's a much smaller chance that the market is going to sustain a rally, especially in tech stocks, which is what we have been seeing lately. So it's you see that breakout right there? So I would be really, really cautious about this breakout because it either means that the market has completely decided that the Fed is not going to raise rates, but at the same time, and the 10-year is now consolidating, and I think what's going to happen is that the stock market's going to cool back off, fill those gaps to the downside, and the bond market is going to fill this gap to the downside as well. Notice we're not really seeing too much upside at this point. And remember, when this goes up, when bonds go up, interest rates go down. I'm not seeing interest rates going down in the near term, not at all, especially after the report that I'm about to share with you today, as far as I could find it here. So let me just get into this part right here, and then I'll get into the whole nitty-gritty. Boston Fed President Collins said Thursday she expects some modest additional policy tightening and then holding through the rest of the year. Now, Thomas Barkin said he had not come to a view yet on what rate increases might be appropriate. At the same time, he said that central banks could raise rates even though further inflation remains above the Fed's target. Inflation is still very high. The job market is still really tight. So to me, it looks like the Fed wants to raise rates. And if the Fed's going to raise rates, that's going to have an impact on bonds. And if that has impact on bonds, that's going to have impact on stocks. So I want to make sure you guys don't confuse this with a big breakout market rally, because that's just not where we're at right now. And if you look at the SPY, broadly speaking, I want to kind of show you this. You will see that it's mainly just going up to the support, to the resistance level up here, and it'll probably come down. I wouldn't be surprised if this area right here, right there, became a new level of resistance, because this is just too much too fast, and it's basically saying we're not going to have interest rate hikes. We're not going to have interest rate hikes. Meanwhile, the Fed is saying there's a good chance we may. So again, it's just one of those things we need to pay attention to, and it's one of those things we have to be really, really mindful of right now. Now, let me get back to my analysis so that I can give you a full report. So U.S. benchmark indices closed higher on Thursday as technology-related shares continue to shine, while investors brace for crucial inflation data that's coming out in the next couple of days. Now, Thursday's session, the S&P notched a 3.5-week high. Keep in mind, in this type of market, that's usually a reversion to the mean type in action. The blue chips posted a 3-week high, and the tech-heavy Nasdaq rose to a 7-month high. Now, again, be very, very cautious, led by tech stocks. Treasury yield retreated following the latest U.S. economic data, and tech stocks also got a boost from a 7% jump in U.S.-listed shares of JD after the Chinese e-commerce giant announced plans to separate. Shares of U.S. regional banks fell. Remember, I told you, be careful with banks right now, after the Biden administration called for tougher measures for mid-sized banks following the collapse of the Silicon Valley and Signature banks. I think we're getting out of danger zone, but we still got to be careful. Fourth quarter GDP was revised to 2.6% higher from 2.7%, showing a slowdown from an increase of 3.2% for the third quarter. And I already told you about what the Fed heads are saying, and they're not saying that they're not going to raise rates. Now, in terms of what the bond market is pricing in, it's pricing in a 57% chance of a 0.25 basis point rate hike and a 42% chance of no hike for the May meeting. Today, all eyes are focused on the U.S. personal consumption expenditures. That's going to be a report that's coming out in a bit. Also, the Michigan consumer sentiment will be reported today as well. Europe. Futures are up 0.25 this morning as market participants digested a slew of important regional economic data ahead of U.S. inflation prices. That's really, really, really important. China, lagged its Asian peers and closed slightly higher today as investors digested mixed Chinese activity data. Data on Friday showed manufacturing activity slowed from the month ago, faltering hopes of a robust post-COVID recovery. And if China's not doing great, that's really going to impact U.S. as well. Japan's Nikkei closed higher after data showed core consumer inflation in Japan's capital, Tokyo, eased in March, although at a slower than expected rate. There's no major earnings today other than a Nikola that's got a SEC registered underwritten public offering. I don't know what that's about, but that's a stock a lot of traders were watching pre-COVID. That's on the table today. Not a lot of other news aside from personal income that's coming out in about an hour, and consumer sentiment. That's the big report that's coming out at 10 a.m. And I'm really curious to hear what Lisa Cook and John Williams have to say. And again, haven't heard anything about Donald Trump or anything of such nature. If we look at momentum levels, which we will do right here, you could see that consumer staples is still coming higher. Infotech, about 61%. Utilities, about 63%. Defensive sectors, except for information technology, consumer staples is utilities. And typically consumer staples don't go up at the same time to tech. That's one of the biggest reasons why I'm so nervous about tech stocks. And also, if you look at Infotech on a longer term basis, right here, you will see that it's just slightly turning up, but it's still all the way from here. It hasn't come down all the way, and it really, really has to come down before we start seeing anything really sustainable or something that would really tell us that this market is going to go higher. Because right now, I'm really, 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 really nervous on the tech sector. Now, as far as sectors, technology, communication services, they're still leading, but I guess industrial, consumer staples, basic materials. This is where I think the action is going to be, and I think the technology and communication services are not going to remain up here. The only way they would remain up here is if the Fed concretely said that interest rates are not going higher. And from where I'm sitting right now, that's not on the table. It's possible, but it can go either way. So we got to be really, really careful right now with where we're standing. Healthcare, energy. Let me just go through the sectors with you. Now, technology is still strong, so I'm looking at individual stocks, but as a whole, be really cautious about a turnaround here, especially with the choppiness. And also, keep in mind, one of the biggest reasons why you're seeing technology rally is chip stocks. Chips are a commodity. They kind of do their own thing. But if you look at the other tech sectors like communication services, notice it's not making a higher high. If you look at consumer discretionary, which is also very interest rate sensitive, it's not making a higher high. And if you look at the chip sector, that's really what's driving this market right now to the upside in terms of the technology sector. So really, really important to get a perspective of what's happening right now. Look at that. So that's really the big deal. So not everything is rosy and peachy in the tech world because look, technology's up here, but communication services can barely get it up. So it's just not the same thing, and it's very, very disturbing to me because I'm seeing the writing on the wall, especially after you see several up days in a row with gaps in the S&P. Let's see if we had those gaps in the Nasdaq too, just out of curiosity. Yeah, I mean, look at that. It's just too much too fast. So we got to be really, really cautious right now because we still don't have confirmation from the Fed that we are in fact going to be moving higher. And as I said right here, bonds, they're not making an ascending trial, they're making a descending triangle, which points to a little more downside, not upside. And if this goes down, interest rates go up. And if interest rates go up, it's not that really great for stocks. So we got to be cautious. So overall, I'm beginning to think that this market, my summary for today is I think this market is getting a little overextended. I think we got to be really, really careful. I think what's happening is investors are getting a little too bullish for their own good, and they don't believe that rates are going higher. That's what they're saying right now. But if you look at the 2-year, if you look at the short-term bond right here, you will see that, in fact, the bond market is starting to turn negative and starting to believe that interest rates may, in fact, be going up and not down. So be really, really cautious over the next few days because I think the market's going to give us a little bit of a pullback. And if that's the case, a lot of tech stocks are going to go down. I'm especially concerned with the fact that technology is moving higher, but these sectors, communication services and consumer discretionary, they're really related. I mean, communication services is mostly tech, and consumer discretionary has a lot of tech too that they're not following along. So be really, really cautious. My suggestion is stick with consumer staples. Stick with industrial right now, stick with basic materials and maybe energies. Be really careful right now on the technology front. It just doesn't seem to be very sustainable because I'm not seeing follow through on two other sectors that are related, and I'm not seeing the bond market following through either. And the Fed seems to be very on whether or not they're going to take action or not. Now, before I let you guys go, and remember, I'm not seeing anything relating to Donald Trump. It's a no news issue in terms of financial markets for the time being, and I'm not expecting it to become an issue because he's not a sitting president anymore. If he was a sitting president, that would be a different story. He's still a public figure, but he doesn't have decision-making abilities in the White House or policy-making decisions. So I'm imagining that's one of the reasons why the market is not being affected as such. Now, folks, before I let you go, in the past 2 weeks, $400 billion has been injected into the economy. And because of this move, a rare buy signal is flashing on one group of market-leading stocks. Today at 1:30 p.m., today Eastern Time, 1:30, right after Ask the Pros Premium, I'm going to go live with a special presentation. I'm going to reveal how to potentially capitalize on these explosive returns that we could see after interest rates peak out. And again, it's still a big question mark, and a lot of people are getting a little too frisky for their own good. Just click the link below to save your spot. It's going to happen at 1:30. We're going to have a really great time, and I'll see you all there. Bye, everyone. Remember, follow the link, like this channel, subscribe, give me feedback, and post comments, and I'll respond. Talk to you guys later. Bye. Have a great, great day ahead.